bear market finally arrives on S&P 500 in US market. What is a bear market? A bear market is when broad market index fall 20% from a recent high. And that happened finally on Monday when S&P 500 fell by 22% from the recent peak it has made in January 2022. So bear markets are always a part of normal market trends. Let us not forget that. And since 1928, we have witnessed 28 bear markets and 27 bull markets. The only difference is the bear market's tenure is much lesser in comparison to that of bull market. So there lies the opportunity in the stock market. Now the question arrives here is, if the bull market has ended and the bear market has commenced, what is next? Friends, if we all know that history teaches us so many lessons. So history lessons us, so we should look at the historical data from the stock market. In past 28 bear markets that the world has witnessed since 1928, the average decline, I'm talking about the average decline, has been around 36%. Which means on an average basis, we can say that another 16% decline is possible as far as S&P 500 goes. And the decline normally on an average basis lasts for 289 days. So these are two important inputs. These are, friends, average. In 2008, we had seen a drawdown of 55% also. In 1929, we had seen much larger drawdown that we have already discussed on the channel when discussed about the markets. One more thing, as a stock market participants, historically, there is no stance that S&P 500 went into the bear market phase while Nifty could not or did not. So it's a time to take precaution. It was only during 2018, if I remember correctly, S&P 500 went, little below 20% and then immediately recovered. That is the only, in 2018, we remember in S&P 500, when it went below 20% and recovered soon and the bull market continued. And at that time also, Nifty saw a sizable drawdown. So today in this video, especially for stock market beginners, I would like to tell you some very important things that should be borne in the mind. Besides, taking a call on your own portfolio stocks, analyze them, do the risk management so that you can save from a bigger drawdown which might happen based on the historical data. So let us discuss all those important points which is to be borne in the mind. Friends, do not forget to like the video and subscribe the channel and hit the notification bell for updates. Friends, the first lesson is to learn is the yield curve spread. If you recall that we brought a video on 15th August 2019 on your Hindi channel, because at that time English channel never existed. So we did talk about the inversion on yield curve that happened in UK and USA on 14th August 2019, giving a warning the possible upcoming of bear market and a recession. Friends, at that point of time, there was not a single case of COVID anywhere in the world. And bear market followed soon in February, March 2020. This time also we made a video on the channel that the yield curve, the 10-year, 2-year constant maturity yield curve has inverted on 1st of April 2022. And the bear market, as far as S&P 500 goes, has already started on 13th June, where the S&P 500 corrected by more than 20%. Which means the only difference is historically, if you see the past 7 yield curve inversion, every time it has corrected well, thus proving to be a very reliable leading indicator. The only difference is this time is that the bear market has come in 2.5 months time post conversion inversion of yield curve. However, the average time used to be 5 to 6 months, which has reduced this time. The only exception is this. However, once again, yield curve has proven to be right as a leading indicator. Now, whether recession will come, it's only time will tell. But in the past 7 occasions, yield curve has correctly predicted the forthcoming recession. Now, the yield curve inverted on 1st April 2022. Again, the flattening curve gives a worry because the yield curve spread today when we are discussing is only 0.03. So is there a possibility of further inversion? Let's wait and watch. Lesson number 2 is always remember rule of 20%. I don't know the magic behind this 20% rule. You might have heard the 80-20 rule, which means even it applies in the corporate world or education system also, where 20% employees of an organization gives a productivity of 80%, means they do 80% of the work of the organization. Rest 80% people only do 20% of the work. If you have read about the Harvard analysis on spends on education, they say that 20% professionals are produced against the fund of allocation, and 80% are normally mediocres. And if you recall, when we were talking about Zero to Hero, the technical analysis series of free tutorial series on your channel, that I am making and doing a hard work to prepare this tutorial series worth lakhs and lakhs of rupees. But I know 20% people will pick up and rest 80% people due to non-willingness or any other aspects may not pick up. Similarly, in the stock market, when market falls from the recent peak by more than 20%, it's a commencement of the bear market, and then market makes a bottom and recovers 20% upside from that bottom, then it's a commencement of the bull market. It is as simple as that, based on this thumb rule, which is proven for several years and several decades. Rule number 3 is very, very important, friends, to remember and understand the potential of a stock market. Stocks normally lose on an average of 36% during the bear market. I'm talking about the good stocks. While in bull market, stocks gain by 114% on an average during the bull market. Does it not call for something to consider investment in the stock market? Yes, friends. Anything that we invest in the stock market or any asset class that can outperform and beat the inflation is obviously a right decision. We have discussed many a times on this channel that stock market is a cyclic phenomenon. There will be business cycle, stock market cycle, sector rotation, all these things will happen, which is quite normal. So rule number 4 is bear markets are quite normal. It might be a bad news because there is a sharp drawdown in the market. But there is another good news is, which is the rule number 5. Bear market has a very short life and short duration. Rule number 6 is that we encounter bear market once in average of 3.6 years. If we analyze and average out the data since 1928-29. But this time the bear market which has come and started on 13th June on S&P 500 is average is 2.3 years, because the last bear market started in February 2020 and this has started in June 2022. So it has started a little earlier. Rule number 7. Bear markets have been less frequent post World War II. We had witnessed during the period 1928 to 1945, 12 bear markets, which means the average was every 1.4 years, there was one bear market. Post 1945, we witnessed 14 bear markets. I'm not including the bear market of current year, which has started yesterday only on 13 June 2020. But since 1945, we witnessed 14 bear markets, means the average calculates to every once in 5.4 years. Now, this is a worry. If you analyze this data and dissect, this calls for a worry, because this bear market, which started on 13th June 2022, has started after 2.3 years. And at this point of time, we have series of global tensions which is going on post Russia-Ukraine war. If it culminates into, it's a wild imagination, as if now there is no possibility, but it culminates into a World War III. My worry has always been, can market repeats the mother of all bear markets like 1929, where we have seen multiple bear markets and a huge drawdown of over 85% in the stock market. And that calls to take for a severe precautions with respect to our investments in the stock market, to choose the right stocks from the fundamentally sound business, and then secondly, only enter the stock when there is a confirmed sign of trend reversal. Rule number 8 is very, very important, friends. And that is why you might have seen, I have been telling since past 15 days or 20 days, very regularly on the channel, that be ready with the sound stocks from the fundamentally sound company, be ready with 20, 25, 30 stocks, so that whenever trend reversal is there, we can position ourselves into the stock market with fundamentally sound stocks. The reason being, historically, if you analyze the stock market, whenever bear market has come or a market has gone into a severe downtrending mode, half of the S&P's 500 index have seen the best days during the bear markets, which means during the accumulation phase. And another 34% best days have come in the first 2 months of bull market. So the critical thing is to understand the chart formation. Technical analysis plays a very significant role when this bear market would be finally over. And before the commencement of the bull market, that is when the price goes past 20% from the bottom, there will be a period where the price action analysis will indicate accumulation phase, and the market is coming out of the accumulation phase, which will be signaled through some kind of reversal chart pattern. And that is the time when we position ourselves, we maximize our profits and earn the money in a shorter period of time. Rule number 9 to remember is that whenever bear market comes, that does not mean that recession will follow. Because since 1929, we have witnessed 26 bear markets, out of which 15 were associated with the recession forthcoming. Yes, one thing is very sure, that there is a slowdown effect in the economy which has been witnessed whenever bear market has arrived. Now the question arises, once the bear market has begun, when will be the bottom stock market will find. Historically, if we check the data of the stock market, the index has taken a median of 52 trading sessions or days to bottom out. So this is a median. So what we say is nobody can enter the market at the bottom. Nobody exit the market at the top. Many a times we feel that it's only the retail investors lose money. It is not the fact. Berkshire Hathaway's equity portfolio has lost an estimated of 65 billion US dollar in this quarter so far. So drawdown affects everybody. It is only through our analytical ability we can minimize the loss and maximize our profit by right positioning. And that is why, friends, my message has always been learn all about the stock market. And we have given an ample number of time to prepare our tutorial series Zero to Hero. There is a separate playlist. All those stock market beginners devote sufficient number of time, a good number of time to understand the market structure by following the videos in sequence manner, starting from Zero to Hero 1. Friends, I hope that this video with various rules based on the historical data of stock market will give a value addition to all those stock market participants tracking this channel. If you want, friends, to continuously engage yourself in the education of the stock market and its analysis, don't forget to like the video, subscribe the channel, hit the notification bell so that you remain updated all the time. Thank you very much for watching. Looking forward to meet you very, very soon.